All right, once again, David Moore here today with Art Scevola. It is Christmas time, so I've got my little red and a little bit of red clothing on, and hey, the Christmas tree. Anyway, we if you've been following along, we went through the introduction, and we were talking about life insurance contracts, policies, the good, the bad, and the ugly. And we are now going to talk about the bad. So, Art, tell us about the bad when we're looking at this whole area.
Well, basically we're at a stage where we've got some great news out there in terms of our economy, and obviously what's happened in the life insurance space is there's been an effect as well on carriers. And carriers, by and large, are fixed income investors. And for the last 10 years, the carriers have not enjoyed great rates of return. So one of the bad things that I want to mention is that if you're holding an interest-sensitive contract, be you a business or an individual or a trust or a charity, it's time to evaluate that or reevaluate that, because interest rates are being reduced inside many, many of those types of contracts to the minimum guaranteed amount. And then to add insult to injury, oftentimes, and this is dominating right now a lot of the insurance press, carriers are having to go to their highest internal charges for mortality and expenses, highest allowable. That has the combined effect of making or resulting in a contract that may not meet up to expectations for as long as is needed. So we have people who either have to step up and pay more money, or we have policies that are going to fail. Again, there are outlets, there are opportunities to reevaluate as to whether that need still exists and what that's worth. So I would say that's the first sort of bad story out there. In terms of life insurance, we've not seen this happen.
So even when we've
before.
got rising rates everywhere else, we've got a situation where things are changing.
Now we do.
Yeah.
But rising rates that's a little bit of a myth for life insurance companies, because they operate on a 10-year bond. So their average rate of yield is somewhere between a 10 and a 12-year bond rate. Those bonds don't unwind just the instant that the Fed decides to step up the rate. It takes time, and so they're suffering through those portfolios, in some senses of the word, having to create more for them than they can, so they're going to increasing their cost of the insurance policy, where and if they can. In a universal life format, they can definitely do that, and so be conscious of that.
So Art, if we're just change a little bit from buying policies or investing in things to take care of it, or to selling your life contract. I mean, with the change in tax reform and obviously more people contemplating the sale, or more people out there mining policies to purchase via the ads and everything else, have we seen a softening of values on those policies?
No, it's still very competitive, David. It actually is a period of which there becomes a bigger awareness, because, as you know, television creates that. So therefore, there becomes an issue of more people involved. And I think what's happening in the capacity has gotten very large to acquire policies. Our particular affiliation is one which has the kind of expertise that cuts across, as I mentioned earlier, all of the components of what is the right price for a life policy that can be delivered to somebody who's a seller. And the question of whether you're a seller or a buyer, again, if you go to the bell curve today, the good, bad, and the ugly theme, the good is that there are a lot more buyers than before in the marketplace, and I think the pricing is very competitive for the seller himself, herself. If you go to the extreme end of the bell curve and you have a high net worth business person or a charity that's got a large amount of, there are abilities now that are in the marketplace to take advantage of the lower interest rates in terms of premium financing opportunities, where I don't have to unlock my assets to be able to pay a premium. And that premium financing strategy has been used for years and years and years, but it's just now sort of, again, refocusing, because we've had these lower interest rates, and there are outlets where we can secure interest rates for the duration of the financing, which is, generally speaking, never more than about 8 or 9 years on a given contract. So that's something that's out there, but you really need to understand that the The bad thing is that we do have an experience right now, in the life insurance carrier area that is not a good experience in terms of what it means to the consumer. And the consumer beware is what I would suggest. Look at your statements if you're the policy owner and make sure you reevaluate. We call it an in-force illustration to say, will it or won't it meet up to specs?
Yeah. All right.
Okay.
Great. Well, one other aspect, this is a little different series for us because typically we're talking about 1031 issues where you can go places to go, how to do these things.
Right.
If we're talking about retirement accounts, typically we're talking about similar subjects. Mm-hmm. And I guess so one last thing bad I'd like to mention in here is so if we're talking about investing, life policies as an investment opportunity for somebody, it doesn't fit our IRA structure today.
Right.
401k plans, you can do this. So if we're talking about investing in these things.
But retirement planning is at the top of the chart still with respect to the new section on 199A. 199A does allow for the purchase of life insurance in that format of retirement planning. But that's a whole different spectrum than an IRA, even the large IRA purchase. Yeah.
This is another conversation, another segment.
Yeah.
All right. So that wraps up the bad segment.
Yeah.
That's all we want to hear about.
Yeah.
That's the critical stuff.
Right.
So once again, David Moore and Art Scevola here today. Thank you, Art, and we'll be right back.
Thank you.